Things are heating up between President-elect Trump and Fed Chair Jerome Powell. At the last FOMC meeting, Powell was asked multiple times about Trump trying to get rid of Powell. And, well, let me just show you how awkward this was.
Hi, Victoria Guido with Politico. Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
You can just feel how awkward everybody felt there, but it didn't stop there. Somebody asked a follow-up question about the same topic.
Do you believe the president has the power to fire or demote you, and has the Fed determined the legality of a president demoting at will any of the other governors with leadership positions?
Not permitted under the law.
Not what?
Not permitted under the law.
Thank you.
Courtney.
Ooh, that was awkward. But this isn't the only time that there's been tension displayed between Powell and Trump. In fact, this story goes back basically to the beginning of their relationship. You see, when Trump took office in January of 2017 for his first term, Janet Yellen was still the chair of the Federal Reserve at that time. Her term ended about 1 year later in February of 2018, which meant that Trump had to appoint the new Fed chairman, which means Powell is actually there because Trump picked him. But it wasn't long before it looked like Trump severely regretted his choice. You see, Jerome Powell went into that role with the assumption that his job at the Federal Reserve was going to be to normalize monetary policy. Because after the great financial crisis, the Federal Reserve had kept interest rates at 0%, it was called ZIRP, zero interest rate policy, for far too long, and they had continued to grow and grow their balance sheet for far too long. And every single time the Federal Reserve tried to stop that path under Obama, something happened and they were not able to stop, and they had to continue down the easy monetary policy path. You can see the Fed lowered interest rates to 0 in 2008, and they kept them there until November of 2015, and even then only raised them slightly until Trump finally got elected and gave the Federal Reserve the room to start raising. Similarly, if you take a look at the Federal Reserve's balance sheet, you can see that they continued to grow their balance sheet, and every time they stopped, something would happen and they'd have to grow it yet again. So Powell went into this job with the expectation that he was going to be shrinking the Federal Reserve's balance sheet, and he was going to be raising interest rates back to a normal level. Now, obviously at the time, this made Trump very upset. In fact, by January of 2020, Trump had tweeted about the Federal Reserve 100 times since nominating Powell. Now, this is because a shrinking balance sheet and higher interest rates do act as economic headwinds. They can make it harder to borrow and spend, and they can push asset prices lower. And in fact, that's exactly what started happening. In 2018, the stock market started experiencing some severe volatility, and even towards the end of 2018 started to crash. But soon the Federal Reserve's tight monetary policy, or getting back to normal monetary policy, came to an end. The Fed gave in and they pivoted. A lot of it was because of this market crash here, but the Federal Reserve finally stopped raising interest rates in January of 2019 and started to hold them steady, even started lowering them in July and August. Once the Federal Reserve stopped raising interest rates, the stock market started off on a brand new bull market. But the pivot didn't stop there, because at the time, the Federal Reserve was still shrinking their balance sheet. So even though they had stopped raising rates, they were still allowing their balance sheet to bleed off. So they had only done a partial pivot. Well, allowing their balance sheet to shrink was having the effect of sucking liquidity out of the financial system. You see, when the Fed's balance sheet is growing, that means they're printing money to buy assets from financial institutions. That's injecting liquidity. When their balance sheet is declining, the opposite is happening. Liquidity is getting sucked away from financial markets. And if you know anything about the way that banks work, this is not very good. You see, financial institutions every single night will go to each other to swap collateral for cash. Some banks will have some extra cash, some banks will need some cash. And if you think this sounds anything like a pawn shop, that's exactly what's going on here. A bank will go to the overnight market and they'll say, hey, I've got some collateral, let me buy some cash from you. They'll swap and they'll say, I promise to repurchase this from you at a certain date in the future. And when they do, they'll swap it back. So some banks will have the cash, some banks will have the collateral, and the cash and collateral get swapped back and forth. Well, what do you think happens when all the cash gets sucked out of the financial market. Well, suddenly what you have is all the banks going to each other at night and saying, hey, I need cash, and everybody says, I need cash, and nobody has any. Now, this is very similar to what led to some of the banks starting to collapse, the great financial crisis. This is the repo market failure, where all of the banks got together and said, hey, I need some cash. Now, in that circumstance, it was the bad collateral that was the issue. Everybody said, hey, here's some mortgage-backed securities, and all the other banks were like, no, we're not going to take that as collateral anymore. So it wasn't an issue of not enough cash, it was an issue of bad collateral. Well, this time in September of 2019, the issue was just there was no cash. The collateral was all good, it was all US Treasuries. There was just no cash. And when you look at the Federal Reserve's balance sheet in September of 2019 is when their balance sheet started growing again, kicking off the next round of quantitative easing. Now, at the time, everybody was calling this not QE because the Federal Reserve said, hey, it's not QE because we're only doing this with short-term securities. This isn't buying long-term debt. Doesn't matter. They're printing money, buying assets, injecting liquidity. It was QE. And so September of 2019 marked the rest of the entire pivot. They had stopped raising interest rates, they had dropped interest rates, and now their balance sheet was growing yet again. And the bull market that kicked off from September of 2019 ran insanely high until the markets finally topped before the crash in February 2020. Now, because of all the trillions of dollars of printing and spending that happened in 2020 and 2021, all of that overshadowed the beef that Trump and Powell had during 2018 and 2019 when they were arguing about rates being a little lower or a little higher, the balance sheet growing by a little, shrinking by a little. That was all overshadowed. But the history is still there. And now, clearly, people are wondering what is going to happen, that Trump is coming back into office and Powell is still there. And clearly, as we saw earlier, Trump cannot remove Powell, but Powell's term is up in May of 2026. That seems like a long way off right now, but it will come soon, and Trump will then need to appoint a new chair for the Fed. But given the fact that Trump's first year and a half of his second term will be with Powell as the chair of the Fed, what can we expect? Well, first, we can expect more of what we're seeing right now, which is that the Federal Reserve has already started cutting rates. After holding rates high for quite some time now, the Federal Reserve has started cutting rates, and the market largely expects the Federal Reserve to continue cutting. Now, the Fed's balance sheet is still declining. However, the rate of that decline is starting to slow. And members of the Federal Reserve have been very vocal that at some point soon, the balance sheet will stop shrinking and they will probably just hold it steady. However, the Fed doing both of these at the same time and expectations about what they'll do in the future is causing long-term rates to rise. If we look at the yield on the 10-year US Treasury, we can see that pretty much since the day the Fed started cutting, interest rates have done nothing but go up. The 10-year Treasury is a great proxy for interest rates on all other forms of debt like auto loans and mortgages because it usually has a pretty similar timeline. Mortgages usually only exist for about 10 years before they're sold or refinanced or something like that. Auto loans are about 7 years, so it's in a good middle ground. Further than that, the 10-year Treasury is short-term enough and liquid enough that financial institutions really like to trade it. It's not super long-term like a 30-year, but it's longer term than something like T-bills, so you don't have to worry about interest rate risk and rolling over your debt every single couple of months. So interest rates across the economy, using the 10-year as a proxy, are rising, even with the Federal Reserve cutting rates and slowing down the pace of their balance sheet decline. So why is it that adding liquidity is causing rates to rise, essentially the economy tightening on itself? Well, it's very simple. The Federal Reserve controls the very shortest end of the curve. They don't control the 10-year or the 30-year or other forms of debt. They control the federal funds rate. This is an overnight rate, and it has the most influence on the shortest end of the curve. Things like T-bills. T-bills, which is US government debt that matures in less than a year. This is the debt that the US government borrows the most of, which means that as the Federal Reserve lowers interest rates, the number one beneficiary of this is the US government itself. They are the ones that get to borrow at the cheaper rate, which means that by the Fed lowering interest rates, it means more deficits, easier borrowing, cheaper debt for the government. And as all dollars are lent into existence, this means the money supply will be driven higher. And in fact, for about 1 year now, the money supply has already been moving higher. Now, as prices move higher, it means that lenders need to compensate themselves for their loss of purchasing power along the way. So if you're tracking with me, this means the Fed lowering interest rates means cheaper government borrowing, means more government spending, means more inflation, so higher prices for all of us, which also means higher rates for all of us. So yes, the Fed lowering rates pushes interest rates up for everyone else. And whoever is in charge of the Federal Reserve, whether it's Powell for the first year and a half of Trump's second term, or whoever Trump appoints, will have to deal with the same exact problem. A bloated Federal Reserve balance sheet, short-term interest rates that are too low, that are causing more inflation, but you got to keep them there to stop the government from going bankrupt, and long-term interest rates that are much too high, that are suppressing economic activity. If history is any guide, Trump is going to be fighting for lower rates, trying to get people access to debt for cheaper so they can borrow and spend and stimulate the economy. But this time is different than his first term because inflation is out of the bag. And so both from a fiscal policy standpoint and a monetary policy standpoint, you're basically looking at, do we sacrifice the dollar or sacrifice the economy? Do we bankrupt the government or bankrupt households? Now, it is possible, the wild card here is that Trump and a red Congress will follow through on the current plans and promises to drastically shrink government spending. Now, if they do this and they cut government spending by trillions, I'm talking minimum 2 trillion, this could help or even solve this problem. It will certainly not crash the economy. That's a video for another time. But the likelihood of that happening is very slim. So as it stands, expect more of what we've been seeing recently. Higher prices and higher interest rates. And not a thing the government or the Federal Reserve will do to stop it. If you want me to help you apply ideas like this to your investing so you can grow your portfolio and protect it during times of crisis, go ahead and click on the link in the description below. As always, thanks so much for watching. Have a great day.